Okay, so today's topic, we are looking at interest rates and bonds. But before we start, let's have a quick devotion. Give God some thanks and ask His blessings on this class. Can you see my screen? Can you hear?
Yes, yes, yes.
Yes.
Hey guys, I hope you're having a great day. One of my favorite verses, Proverbs 3, verse 5 and 6. It says, "Trust in the Lord with all of your heart. Lean not upon your own understanding. Acknowledge Him in all your ways, and He will direct your paths." Guys, it's so hard to trust in the Lord with all your heart, especially when all you see are broken pieces or storms in life and everything feels like it's crumbling all around you. The Lord is faithful. He loves you, and He will carry you through when you cannot walk. He has a plan for you. Don't lean upon your own understanding. I mean, in my own understanding, a life without limbs, how could I ever live a life without limits? It's only because God had a good plan. God has an awesome plan for you, and His grace is sufficient no matter what you're going through. Pray to Him, and as you draw near to Him, He will draw near to you. God bless you and your family today, and keep that in mind. Trust the Lord with all your heart. Lean not upon your own understanding. Acknowledge Him in all of your ways, and He will direct your paths.
Right, the message was short, so I hope that we can really find that space where we can really trust the Lord in everything that we're going through. I know studying could be a challenge many times, but if you cling to that promise, God would definitely see you through. Let's pray. Father God, thank you for this another day for life, health, strength, Lord, that you've given us the opportunity to do online learning. We ask for your blessing upon the technology, Father, that all would go well. I pray for each student here that you would be with them and their families, Lord, that you would provide for all their needs. Lord, you'd give them the wisdom and the guidance, and more so the strength to continue on this journey. You have the plan for each one, oh God, and I ask that your will would be done in their lives. Thank you for this opportunity of teaching and learning, and may your will be done, I pray, in Jesus' name. Amen. So in chapter 6, I also teach principles of finance to my class, and we are on the same thing, interest rates and bonds. So our learning objective this afternoon is, okay, our learning objective this afternoon is to describe interest rate fundamentals, the term structure of interest rates and the risk premiums, review the legal aspect of bond financing and bond costs, and discuss the general features of yield prices, popular types, and international issues of corporate bonds. Now, when you hear the term interest rates, what do you think? What do you think? What you're thinking about? Or what does it apply to? Don't rush. Anybody? When you think of interest rates, what you're thinking about? What do you think we're going to talk about today? What about interest rates? What is interest rates? Donna says taking a loan. Anyone else? Nothing? All right. So when you hear about bonds, anybody know what a bond is? Not the physical term bond where you put things together, What bond? Anybody know what a bond is? Hey,
A
this class got...
long
Oh,
term,
sorry.
a long-term debt instrument.
Yes, it's a long-term debt instrument. And companies or the government, they use bonds to raise money. So sometimes a company may need money instead of going to a bank, which they have the option to go to a financial institution and get a loan. They issue what you call bonds. So they're looking for money to do some developments. The government is looking for some money to build the highway. How they raise that money? Not just taxes, they issue bonds. So they need $10 million to build this highway. Or should be more, 200 million. What they do, they issue bonds. Bonds mean they sell this $1,000 packages, and when they sell it, so I would buy one, you would buy one, companies buy millions, and they take the money, they give you a certificate or a piece of paper that says it's a bond. Well, now we do electronic, so it's not a paper. And they're going to give you interest on this bond. So the bond usually carries some years. We'll go further into it. The bond carries some years. So when those years are finished, the government now would give you back your money. But all through those years, you'll be getting interest. Isn't that something that you would like to invest in? You think that's a good deal?
Yes, ma'am.
Yeah, right. So that's why it's important for us to learn now about how interest rates, when we're choosing these type of investments, how interest rates apply, and especially what risk is involved in terms of these investments. So interest rates and required returns. So sometimes they use it interchangeably, interest rates or required return. When we say interest rates, we are specifically talking about, loans, as somebody said, or bonds. They pay us interest rates. Or you'd hear required return. Required return usually focus on equity instruments like stocks, right? So when you buy into a company, ownership into a company, you get dividend returns, right? This is called required return. So it's similar, it's the same thing. But when we say interest rates, we're really referring to debt instruments. When we say required return, we're referring to equity instruments. Just know the two differences. Now, there are several factors that determine interest rates. So we know interest rates. If we go to the unit trust, we go to another bank or savings account, we get interest rates of 0.02, 0.1. How do they come up with these interest rates? What determines these interest rates? The equilibrium, the rate of interest, is influenced by inflation. Inflation, anybody know what inflation is? Well, this is a finance class, yeah. What is inflation? The increase in price of goods over time, right? So interest rates is determined by inflation, risk, meaning that if there's a likelihood that I am not going to get back my investment, then it should be paying me a higher return. If the likelihood that I'll get it back, then I'll get a lower return. So that's sometimes you see some of those investments that are paying so high, know that the expected risk is very high. Liquidity now. Liquidity refers to the general tendency of investors to prefer short-term securities. So liquid means you want your cash as fast as possible. So you want it in the short term. If you keep it in the long term, then it's not liquid. It have to be invested in something that might be risky to get a higher interest. So inflation, risk, and liquidity, those are the fundamentals that influence this interest rates. The real rate of interest. So we talk about interest rates, required returns. Now there's the real rate of interest. The real rate of interest is the rate that creates equilibrium between the supply of savings and the demand for investment. Now, who are the suppliers of funds? We would have done that in chapter 2. Who are the suppliers of funds? You don't remember? I don't buy it. I'm behind the screen.
Households, miss?
Yes, householders supply funds. And what about demanders? Who are the demanders of funds? Who need the money?
The banks.
The government, and business owners, companies. They need the money. The bank acts as the intermediary. Right? They take the suppliers of funds, so our funds, individuals, and they loan it to demanders of funds, banks and the companies, and in turn, they give us a interest rate return for our money. So the real rate of interest is this equilibrium, right? In a perfect world where there's no inflation, where suppliers and demanders of funds have no liquidity preference and there is no risk. And we know this world is not perfect, right? So the real rate of interest changes with changing economic conditions, tastes, and preferences. Look at this diagram to show us how this equilibrium works. So if you have done econ, micro, we would have learned macro. The suppliers, look at the demand for the demanders for funds. So we have the D line, the blue line representing the demand for funds. When the supply meets the demand, we have an equilibrium state. What the diagram is showing us is, while we're at an equilibrium, demand meets supply at the real interest rate of 0. When the supply of funds fall, so when individuals decide that they don't want to put their money in the bank again, right, interest rate falls. So what do you think would happen if suppliers have excess cash? If suppliers were to have excess cash and they put more money, what will happen to the demand? What will happen to interest rates?
Increase.
It increases, right? So we're going to take those things into consideration as we go forward. Now, so we talk about interest rates and required return being the same. We talk about real interest rates. There's a perfect world with no inflation, no liquidity preferences, now and no risk. Now we're going to look at the nominal rate of interest. Now this is the actual rate of interest charged by the supplier of funds and paid by the demander. So in this world, we look at nominal rate of interest. So when we're talking about interest rates from now on going forward, is really the nominal interest rates, which takes into consideration these two factors: inflation, an inflation premium, and a risk premium. So how do we determine that interest rate? We need to consider the inflation premium and the risk premium. Now, the nominal rate of interest for security 1 is given by the following equation. So this is the equation here. Nominal rate of interest, R1, is equal to R star, which is the real rate of interest, plus the inflation premium, IP, plus the risk premium. RP is risk premium. So if you realize, we are taking into consideration this nominal rates, we are taking into consideration inflation and risk. So to sum it up, they consider the real rate of interest plus inflation to be RF. Anybody could think of an instrument that doesn't have any inflation. They should have inflation. When you look at the consumer price index, it normally gives us the rate of inflation, or the price of goods, which takes into consideration inflation. So we consider this the risk-free rate. The risk-free rate is RF, which is the real rate plus the inflation premium plus the risk premium. Right? So you're confused. Let's go to an example. Marilyn Cabo has $10 that can spend on candy, that she can spend on candy costing 25 cents per piece. So today, October, she has $10 and candy is 25 cents. How much candy can she buy? 40 candies, right? Now, the nominal rate of interest on a one-year deposit, so when we hear nominal, we're thinking about inflation and the risk premium. So the interest rate for 1 year is 7%. So in 1 year from now, if she deposits that money, she gets 7%. However, the expected rate of inflation, which we said is the price of goods over the coming year, is 4%. So what do you think happening here? If you get a problem like this, what is it saying? What is it saying about your $10? What is it saying about your candy?
Is it that the cost of candy will increase by 4% over the next year?
Correct, right? What else is it? What else will increase? So inflation will be the price of goods. But what about your investment? Your 1 year investment will get 7%. So if you put your money in the bank and leave it there for a whole year, you expect to get nothing? You should get something, right? You want to know what that interest rate is. So Marilyn invested the $10. Instead of she spending it today, she invested it. So how many pieces of candy can she buy in 1 year? We said that the price of candy, all right, so let's look at what she would get. In 1 year, Marilyn would get 7% of her $10, which is $10.70. But the price of the candy is no longer 25 cents. It's now 4% by 25% is 26 cents. So how much candy can she buy 1 year from now? She now has $10.70 divided by 26 cents. She can get 41.2 pieces of candy. Got it?
Yes, miss.
So in turn, she got 3% increase in her buying power. So you see the benefit of investing, right? So Marilyn's real rate of return is really 3%, not 7%, 3%, right? So you realize that the nominal rate is for 7. So yes, she could buy 7. She can get 7% for her dollar. But when goods go up in price, what is that real rate of return? That's what the real rate of return is telling you, right? So you're making your investment for your future for next 10 years. And the bank is giving you a 5%. But you have to consider inflation. You could buy something now, but you can't buy that same thing in the next 5 years for that price. So your return would not be 5%. It has to be adjusted with inflation. Yes, Michaela.
Yes, hi, miss. Is that how people do Bitcoin and all those money investing programs?
How they do it?
Is
Be a
that
little
like
more
part of the
specific.
process?
Bitcoin is a form of currency, right? So we have you have money, you have paper money, you have currency, you have US dollars, you have Canadian dollars, you have gold, right? They have stocks. It's a form of investment. So they use this Bitcoin. Bitcoin come underneath it now, or they call it crypto coin or digital coin as a form of money. So when they're doing their investment, right, they invested in something. And this will take you to another class to show you how money works. I think this should have been done in chapter 1 or 2. So we know the suppliers and the demanders of funds, but with Bitcoin, there's no supplier or demander. It's just in the digital world, right? So as the more the demand for the Bitcoin, the price goes up. That's a whole lesson by itself. But here we're talking about how interest rates work here, right? Based on the currency we know as the money, because we know central bank operates our currency, right? Each central bank in each country operates our currency. And we know how much money is in the country and who has it, right? And so interest rate is affected, and inflation with the economy. Those in econ will give you more illustration, right? But the point we're making here, I don't want you to miss, the nominal interest rate or the rate of return, if I use it interchangeably, is what we are normally given, right? You hear the interest rate is this. But what is your real interest rate? Your real interest rate incorporates your inflation and the risk premium. We ignore the risk premium in this example, but it takes into consideration inflation, how it affects the rate of interest that you would get on your money in making decisions, right? So the term structure of interest rates is the relationship between maturity and rate of return for bonds with similar level of risk. A graphical depiction of the term structure of interest rates is called the yield curve. The yield to maturity is the compound annual rate of return earned on a debt security purchased on a given day and held at maturity. So basically, they're saying the whole structure of this interest rates is based on time. Maturity, time, and the rate of return. And then there's this curve that also shows you the yield. Yield meaning the interest at maturity. And we're referring to bonds, right? Because we're talking interest rates. So the curve here illustrates this. On the horizontal axis, you see yield to maturity. Another word, I would call it interest rates. All right? Let's not get confused. It's a form of interest rates. It's like the real rate of interest. And on the vertical line, you have the time to maturity, years. So let's look at a bond. Remember I told you a bond is the government issuing, they need to raise $10 million. Let's, for simplicity, let's work at that $10,000. Each bond is sold for $1,000. So how many bonds do you think they're selling? 10. 10, yeah, 10 bonds. They're selling a bond for $10. And maturity means is years. So normally a bond ranges from 10 to 30 years. And what this means is that for each year, so let's say it's a 10-year bond, there's a coupon rate that they're going to pay. So let's call it 10%. They're going to pay a coupon rate of 10%. 10% means you get 10% interest of your $1,000. 10% interest of your $1,000 is $10. $100. So your coupon rate is $100. It means that for the next 10 years, every year the government will give you $100, right? When year 10 reach, you get your $100 plus your $1,000. Isn't that a good investment? No? Nobody's interested in that?
That sounds good.
Right, right. So you could, when you finish this class, look to invest in a little bond, right? Right, so we have here question. Does the rate normally be so high? 10%. It could be lower, but that's why we're going through this. So we'll see when it will be lower, when it will be higher. So look at the rates that's given here. So a 10-year bond. Look at the first line, the yellow line. What is happening with this curve? How do you interpret this? What is happening with this curve? As time goes by, more time goes by, what's happening to interest rates?
Increase.
This is going up. Yeah, it's going up. So you could say the longer term, you get a higher interest, right? Somebody was asking about interest. So the longer term, you get a higher interest. That was in 2013. In 1989, look at this, what's happening. It remained the same, no matter how much years you have this bond, interest rate remained the same. And in 1981, you have a bond that's, it's reducing. What is it? It's reducing, it's falling as the years go by. So which type of bond would you be interested in if I was to label them? A, B, C. Which bond would you be interested in?
C.
Right. Yeah, the longer term, you get a higher interest. And that's the principle here behind investments as well, right? The longer you have your investments, you should get a higher return. So this yield curve, this normal yield curve is the upward sloping, right? This is the one that we want. Upward sloping yield curve indicates that the long-term interest rates are generally higher than shorter interest rates. The inverted yield curve is the downward sloping yield curve indicates that the shorter term interest rates are generally higher than longer term interest rates. The flat curve now is the yield curve that indicates that interest rates do not vary at different maturities. Now there are three theories. Just going to go through them quickly so you can get a little to the calculations. Three theories are frequently cited to explain the general shape of these curves. So we're saying when the interest rate is going, when the years are more, interest rates goes up, right? Expectation theory, liquidity preference, market segmentation theory. Those are the three theories. Now, suppose that a 5-year treasury note currently offers a 3% annual return. So sometimes you hear treasury notes or you hear treasury bond. Once it's treasury, you know it's from the government. So they could interchange it and put note or bond, right? It currently offers a 3% annual return. Investors believe that interest rates are going to decline. And 5 years from now, they expect the rate on a 5-year treasury note to be 2.5. So if I take the same curve, and I have interest rates here, 1, 2, 3. And I have here 5, 10, 15. This is the years, right? And this is a yield. Tell me what will happen, how this curve would look. If, as they're saying here, it's currently 3%, but the investor expects it to decline to 2.5%. Is this a downward or upward sloping?
Downward.
Right, it will be going downward, right? Because they expected 10 years, it will be 2.5. According to this theory, what is the return that a 10-year treasury note has to offer today? It simply means, because of this theory, in 5 years, the investor is going to get 5 years, 3%. So let's say 3 by 5, 15. And in the next 5 years, it's going to drop 2.5 by 5, which will give us, that's what, 12.5. 12.5. So it just means, remember, they're paying annually, right? Just means that if they hold that bond for 10 years, if they decide to buy that bond, they will get 27.5. However, if the bond was paying 2.75 for the full 10 years, they will get back the same 27.5, right? So we know this yield curve is downward sloping based on expectation theory. Liquidity now. Liquidity is where we want our cash. We want our cash at hand. We want it in the short term. Suggests that a long-term rates are generally higher than short-term rates, right? So this yield curve now is upward sloping because they want to have, more interest rates. More interest rates. This curve will be upward sloping as the years go by, because investors perceive short-term investments to be more liquid and less risky. So to get people to keep their money longer, interest rates is going to go up. Borrowers must offer high rates of interest on long-term bonds to entice investors away from their preferred short-term securities. So you want to prevent people from taking out their money. You have to give them an incentive, right, of increasing interest rates. So the longer you have your money there, the more interest rates you get. That's a liquidity theory. The market segmentation now suggests that the market for loans is segmented, right? Segmented on the basis of maturity, and that the supply of and the demand for loans within each segment determines its prevailing interest rate. So this one works for the equilibrium. So the slope of the yield curve is determined by the general relationship between the prevailing rates in each segment. So this one is not downward sloping or upward sloping. It's just based on the demand for the funds and the supply for the funds. So it can change anytime. That's a market segmentation theory. Now, so far we have considered only risk-free U.S. Treasury securities, or we want to call it in our local parlance, Treasury securities, so bonds. The nominal rate now, right? So we were talking about risk-free. So when you hear risk-free, the only asset that is risk-free is bonds, Treasury bonds. Anything you see from the government is risk-free. There's no risk involved. So what do you expect the interest rates to be, high or low? Anybody know a little about investments? If you're investing in something with no risk, will the interest rate be high or low?
Low.
It'll be low, right? So if that's your risk preference, right, as an investor, you don't want to get into too much risky thing. You want your money safe. A treasury bond is very safe, right? There's no risk. Because why? The government is the provider of funds, right? So they will definitely have money to give you back. But if you invest in something as Bitcoin, who owns the Bitcoin? It's risky, right? You'll expect the interest rates to be high. So the nominal rate of interest for a security is equal to the risk-free rate, consisting of a real rate of interest, as we will call it, our treasury bill or bond, plus the inflationary expectation, plus the risk premium. So we're going into nominal now, considering risk. So the risk premium varies with specific issuer and issue characteristics. Now, a nominal rate on the number of classes of long-term securities in May 2013 were. So look at this first table. We see U.S. Treasury bonds. The nominal rate of interest, which takes into consideration inflation and risk, is 3.18. Corporate bonds, which belongs to companies, not the government. You have high quality ones, medium, speculative, we'll talk about them. these type of bonds a little later. 3.94 for high, medium 4.76, speculative 5.46. Now, tell me what you observe there in that table with the percentages. What is happening there? I just gave the example about the treasury bonds and the bitcoins. So what is happening there? Anybody? No? Look at it.
It's
Go ahead.
increased them.
Sorry?
It's increased them.
Yeah, the higher risk bonds has the higher interest rates. You see, the more risk involved, the interest rate goes up. So just as I said, a treasury bond will give you the lowest interest rates because there's no risk. But as you start to put risk on it, it goes up. So let's look at a high quality bond. So a high quality bond would be a very good company issuing this bond like Facebook. Right? A medium quality bond might be one that is a bank. Let's say FCB. Speculative now would be DSS. It's Unibond. Why would be speculative? It's high risk because maybe nobody hear about it or maybe it's the first time. So to entice people to invest, they issue a higher interest. You got that? Yeah? No? Should I repeat?
Yes, miss, you can repeat.
Right. So treasury bond, as I said, there's minimum risk, no risk. So if you realize what interest rate is lower, but as the bond has more risk, interest rate is going up. I don't want to put it downside, but interest rate is going up, right? So a high quality bond, we'll talk about different bonds later. AAA, AA is 3.94. So I'm saying a company, a corporate bond, a company like that would be like a safe company, you know, making a lot of money. So I'm saying like Facebook, right? They would issue, they will be in the high quality. So their bonds will be range around that. At least that time, I don't think Facebook was around that time. A medium quality bond, I said, will be like a bank. You know, they mightn't default, but they're not backed by the government. No, it shouldn't be FCB, it should be another one. Just an example. And speculative now will be a company where you're not too sure about issuing a bond. They will issue a higher rates, give you higher return because, you know, maybe they're not so secure. This is the first time, you know, you don't understand their management and that kind of thing. Rating agencies give them classes. We look at it just now. So if I ask you to calculate the risk premium for high quality, let's call them Facebook, what's the risk premium involved here? If this represents no risk, we take the return minus the risk premium. Sorry, not the risk premium. We take the nominal rate and we minus the risk-free rate and we get the risk premium. For the medium-sized bond, we take the nominal rate as the rate of return that they're paying, minus it from the risk-free rate, and we get the risk premium. Same thing here. So the risk premium again is higher for the speculative bond. Now, a corporate bond is a long-term debt instrument indicating that a corporation has borrowed a certain amount of money and promises to repay it in the future under clearly defined terms. So in the corporate bond, you have these coupon interest rates. So long time when they used to issue bonds, they will issue a bond. So let's say you buy a $1,000 bond. For 10 years, they will issue something like this, right? A piece of paper. And they will say coupon interest rates. Why they call it coupon? Because this bond will have these little coupon things inside of them. They'll be perforated. And you go and they could be ripped out. So let's say it's 10 of these, right? 10, not 10, it should be 20. Let's say it's 20 of these, right? So every year, right, so this is what you call interest coupon rates. So each one will have 10% on it, 10%. This is the interest rate they're paying on it, right? 10%. This will be paid annually, typically in 2 semi-annual payments. So every 6 months, you go to the company and they would rip out one and give you your interest rates. So let's say the interest rate was $100. You're going back to the $1,000 bond, right? You paid $1,000 for it and they gave you this bond paper. So every 6 months, twice a year, you go and they rip it out and they give you your $100, your interest rates. The bond's par value, so when you hear par value, or if you don't hear par, they will say face value of a bond is the amount borrowed by the company, right? So the face value would be the amount they borrow from you. Normally, it is $1,000. All the time, I should say, it is $1,000. That's how bonds are sold, in $1,000 tranchements. So maybe they're raising 10 million, but it's 10 million divided by 1,000. So they know how much they're selling, right? So par value represents 1,000. The bond maturity date, so if it's 10 years, here you'll get about 20 coupons because it's twice a year. At the time at which the bond comes due and the principal amount is paid. So by the end of the 10th year, all your coupons should finish, right? So they'll give you back your $1,000. Do you understand what a bond is? We don't have the coupon things now, people, that we do. Everything is digital now, so it comes to your bank account. But that was the initial concept, how they came about with coupon interest rates, right? But this is how it functions. You don't understand? Should I repeat? All right, so legal aspects of a corporate bond. So the bond indenture is a legal document that specifies both the rights of the bondholder and the duties of the issuing corporation. So if a company is inviting you to bring money in, it has to be a legal document, right? When you give companies your money, some type of investment, you may be looking for a company and you want to put the company's money into an investment, right? It has to have some kind of legal aspect to it. You don't just hand them $3,000 and they promise to pay you what. So the legal aspect of it is there's a standard debt provision in it called a bond indenture, specifying certain record keeping and general business practices, right? You see so many people being scammed with their money because they don't understand these principles, right? When you're putting in your money, there must be some certain record keeping. Ask for the records. What is the business into? How are you going to get paid, right? That the bond issuer must follow. Normally, they do not place a burden on the financially sound business. So if they don't have any records of business activities, you have no idea what they're selling, what this business is about, how they're going to give you back your money, then you know that's something wrong there. They need to have some legal aspect of this business or this investment. Restrictive covenants are provisions on the bond indenture that places operating and financial constraints on the borrower. You really want to make sure that your bond or the interest rates, everything that is paying is clear. So there are the legal aspects to it. The most common restrictive covenants do follow. They require a minimum level of liquidity to ensure against loan defaults. Liquidity means they have cash, right? So the companies who are issuing these bonds, right, they may not call them bonds, they might just tell you some investments, right? You make sure that they are required by law to have some type of cash, just in case they can't pay, the money is sitting there in account, or there's some assets to convert so you can get back your money. So again, I'm bringing in the issue of the DSS. There should be some type of collateral so that people can get back their money. prohibit the sale of accounts receivables to generate cash. They impose fixed asset restrictions, they constrain subsequent borrowing, and they limit the firm's annual cash dividend payments to a specified percentage or amount. Their sinking funds requirements are restrictive provisions often included on a bond indenture, providing for the systematic retirement of bonds prior to their maturity. Their security interest rates. A trustee also is a paid individual or corporation or commercial bank's department that acts on third parties. So these are the legal aspects of holding a bond. Now, the cost of a bond to the user. How much is this bond really costing? We know it's $1,000 value, but what is the cost of the bond? In general, the longer the bond's maturity, and I highlighted there, the higher the interest rates to the firm. In addition, the larger the size of the offering, the lower would be the cost of the bond. So if they just want 10,000, you're going to get a higher interest rate. If it's large, you're going to get a lower interest rate. Also, greater default risk, meaning that a likelihood that they might not pay, the higher cost of the issue. So that's why you see when you go to those investments and they're paying you 100 and how much percent, know that there is a default risk. They may not be able to pay. Finally, the cost of money in the capital market is the basis for determining a bond's coupon interest rates. Right? So the interest rate is not just falling from the air, it is based on the market. Now, there are different features of a bond: conversion bond and a call feature. This simply means that the company can, while they issue a bond for 10, let's say 20 years, they can decide at the 15th year, we're calling the bond. Calling the bond means they want to pay off the $1,000 or par value, and the end of the bond stops. They usually do that because interest rates have fallen. Right? Then there are convertible bonds. Companies can decide, instead of giving you back your $1,000, we're going to give you a stock. We're going to give you a share price of the bond. Now, quickly, I just want to go through bond trading. Bond trading is not readily available to individuals. So there's a cost of the bond. So although most corporate bonds are issued with a par or face value of $1,000, all bonds are quoted as a percentage of par. So we have a diagram here from the text. This is how you see it listed. You'd see it listed in the newspaper. You'd see it listed on your stock market. If you're here in Trinidad or the US, you'd see how it's listed. So company A, B, C, D, E. Coupon rates. This will be the rate of interest each year. Maturity, how many years remaining or when it would mature. Price. You notice the price of the bond is not $1,000, right? So we just multiply. All the face value is always $1,000. So when we multiply by this percent, the price of the bond is $990.51. We multiply by the 1,000, this bond is 940.07, and so forth. Now, Moody's and Standards & Poor bond rating. These are people. Moody's is a company. Standards & Poor, S&P, they rate bonds, right, based on the quality of the bonds. Because we said if the bond is risky, speculative, they're going to pay a high interest. So when you look at the bonds, you don't want to know how it's paying. So Moody's use AA, AAA, B, C. Standards use AAA, same thing, AAA, AA in caps. But it just means bonds with A quality are good bonds. B's are speculative. C are low grade. So which bond you think would pay a higher interest rate? A, B, or C?
Amos?
No, higher interest rate, it means it is risky. More riskier the bond will be C. If it's low, interest rate is low, it will be A. It's a good bond. But if you're taking in more risk, you expect to get more returns. There are international bonds, right? So you hear Eurobond. I think you'd have discussed that before. Eurobond is issued by an international borrower and sold in an investor in a country. So a foreign currency investing here in Trinidad with currency other than the currency in which the bond is denominated. So they could be selling it in Canadian dollars. That's a euro bond. It's not in Europe, but it's just in foreign currency. A foreign bond now would be a bond issuer hosting a bond in his country with a host country's currency, but a foreign borrower. Valuation fundamentals. Now we're going to look at how we value a bond, which is a type of debt instrument. Valuation now is the process that links this risk and return to determine the worth of an asset. So there are three key inputs to the valuation process. It's the cash flows, right? We look at how much is coming in from the investment, the timing, so how many years or how is this asset paying? Is it annually, semi-annually? And a measure of risk which determines the required return of this asset. Now, basic valuation models, the value of any asset is the present value of all future cash flows it is expected to provide over the relevant time period. The value of an asset at time zero, which is the time now, can be expressed as, this is the equation, value of the asset equals CT's cash flow for the first year divided by 1 plus the required return or discount rates in case of a bond plus the cash flow for the second year over divided by 1 plus the required rate of return to the second power or the second year, and so forth until you reach the number of years that this asset will be held. Now, just some more fundamentals. As noted earlier, bonds are long-term debt instruments used by businesses and governments to raise large sums of money, typically from a diverse group of lenders. So again, the government needs money to build a bridge, build roads. What they do, they issue bonds. Bonds are long-term, 10 to 30 years, right? They normally issue at par, what we call par, $1,000 for a bond. An investor can buy a bond for $1,000 and hold it for the 10 years, 20 years, or 30 years, as the case may be of the bond. The bond pays a semi-annual interest. Right, so most bonds pay a semi-annual, means twice a year, as a stated coupon interest rate. Have an initial maturity of 10 to 30 years and have a par value of $1,000. So again, the investor buys the bond for $1,000. They can keep it from 10 to 30 years. Each year, they're going to receive a interest rate. We call it coupon interest rates, right? It's usually paid semi-annually, so it's usually paid twice per year. Now let's look at an example. Mills Company, a large defense contractor, on January 1st, 2016, so this is a corporate bond, issued a 10% coupon interest rate 10-year bond with a $1,000 par value that pays interest annually. So this question is telling us the information here we can gather before we go. The bond is paying 10% interest. It's 10 years, not 20 or 30 years, and it's at par, 1,000, and it pays interest annually, not semi-annually as was said before. So this one is paying annually. So investors who buy this bond, they receive a contractual right to 2 cash flows, right? So what do they get from buying this bond? They get, where's my pen? They get $1,000 annually because the bond is 1,000. The coupon interest is 10%. So 10% of 1,000 give you $100. So every year for 10 years, they get $100 if they purchase this bond. At the end of the year, the 10th year, they get back their $1,000 par value. So this is the cash flow that they receive from this investment. $1,000 back plus $100 every year for 10 years. Assuming that interest on Mills Company bond issued is paid annually and that the required return is equal to the bond coupon rate, interest rate is 100, coupon rate or interest rate, same thing, or payment is 10%. So interest rate is 10%, payment is 100. The value of the bond is 1,000, this is par, and the number of years is 10. So this is what the formula figures we plugged into this formula to get the value of the bond. Now let me show you how we use the calculator. Right, when we're using the calculator, we are inputting, let me do a demonstration. Right, so in our calculator now, we have the future value of the bond, which is $1,000, right, par. We know NP is the number of periods, it's 10 years. Payment is $100, will be paid each year, and the interest rate is 10%. What we want to calculate is the present value of this bond. Present value of the bond is $1,000. This is how we use the calculator. Right, so here you have it. When we plug in the future value of the bond, we paid at the 10 years. At the 10th year, period 10 years, payment 100, interest rate 10%, we find the value of the bond is 1,000. So someone buying into this bond, they will pay 1,000 for the bond. In practice, the value of a bond in the marketplace is rarely equal to its par value. So if you keep in mind, I'm saying par value or face value is $1,000. But in practice, the value of this bond in the marketplace is rarely equal to par value. Normally it's more, sometimes it's less than par value. Whenever the required return on a bond differs from the bond's coupon interest rates, the bond value will differ from its par value. The required return is likely to differ from the coupon interest rate because either of economic conditions that have changed, causing a basic shift in the basic cost of long-term funds, or the firm's risk has changed. So let's say the firm is more risky, their bond is more risky, and they may find it hard to sell that bond. It's dropped its value, it's dropped its rating, not value, it's dropped its rating. They might find it hard to sell it. They can't sell it at $1,000, they have to sell it as less, right? Then you might have a good bad economic conditions such as now, and investors are looking, well, they're not looking for places to invest their money because nothing much is giving. And the government or whoever wants to raise money, company wants to raise money, they can issue a bond at a high price, paying a good interest so that it can entice investors to invest. So the bond price could be more than par, meaning more than 1,000 or less than 1,000. Increase in basic cost of long-term funds or risk will raise the required return, right? And decrease in cost of funds or in risk will lower the required return. We're going to look at the returns now. So look at this example. What if the required rate for Mills Company bond rose from 12%, not 10%, 12%, or fell to 8%? What is the value of the bond? Here the table shows us, right? The value of the bond would be, using that formula there and our calculator, the value of the bond is $887. You see, when it's 12%, right, you pay less. Now, when it's 8%, realize you pay more. Now, I need to show you it in the calculator. So this is the demonstration in the calculator. If it's 12%, we input 1,000 par value, future value, or par, 10% for the 10 years is the period, $100 is the payment, but they've raised the interest rate, or they've raised the coupon rate to 12%. So now the present value of this bond is 887. Same thing here. If we lower the interest rate, the value of the bond now is 1,134. It's different or differs from par. This is your Excel example. If you're comfortable with using Excel, same answer. Now the graph will show us, and to prove our points, when interest rates falls, you pay more for the bond, right? So you come like you're paying a premium for the bond. When interest rates goes up, the bond is lower. The bond price is lower. The bond value is lower. Now we have what we call Ytm, yield to maturity. This is the rate of return that investors earn if they buy a bond at a specific price and hold it until maturity. So the bond pays the coupon interest rate. So we know the coupon interest rate is based on par. The investor gets the coupon interest rates every year plus their $1,000 par, even though they paid $800 for it year 1. Come year 10, they're going to get back par, 1,000. They always get back par. So when we work out all of that, this is what we call the yield to maturity. How much they're getting in terms of coupon interest rates and their value based on par, right? So the yield to maturity on a bond with a current price equal to par will always equal its interest rates. It will always equal 10%. When the bond value differs from par, so when it's not 1,000, the yield to maturity will be different from the coupon interest rate. So how do we find this yield to maturity? The example says, the Mill Company bond, which currently sells at 1,080, so it's not selling at par, has a coupon of 10%, right? Coupon of 10% and a par value of 1,000. It pays interest annually and has 10 years to maturity. What is the yield to maturity on the bond? Right, it can be 10% because the selling price or the value of the bond is 1080. So what is the percentage return? In our calculator, we put in the present value of the bond. We're paying 1080 for it. The future value at the end of 10 years is 1,000. Number of periods, 10. Payment, it's paying 1,000. And we solve for IR, which would be your YTM in this case, and it gives you 8.76 point 8.6, but you can round it up 8.76%. So that's the yield to maturity you get on this bond. So we're seeing it's 10% par, it's 10% on par, but the value of the bond it's different from par. So we need to find out what is that real interest rates or yield to maturity that you are going to get, the person is going to get from purchasing this bond. This is the Excel example. If you're comfortable again with Excel, right, you put down the years, number of years, and the cash flow for each years, and you solve for YTM using the function key IRR, right? It's discounting the cash flow. This is another formula you use in Excel called the function of a rate, whichever one you're comfortable with. Now, this yield to maturity, it's easy to calculate when it's annually, but in most cases, as we said, bonds usually pay semi-annually. And even if it's not a bond or another type of investment, it can pay quarterly, 365 days. So let's see how this conversion works. This conversion simply works by dividing the interest rate for the period by 2. We're dividing the payments, because the payments is no longer annually, by 2, and we are going to multiply the periods by 2. This is what the formula is telling us. So I over 2, so we divide the interest rates by 2. M is the par value, and and 2, so we multiply 2 by the period. Multiplying this by the period, we divided the interest by 2, because it's two times per year. So our example here, let's look at the example. Assume that the milk company bond pays interest semi-annually and that the required stated annual return RD is 12% for similar risk bonds that also pay semi-annually interest. Substitute these values. When we substitute these values in the formula, we get 885. Now let's look at our calculator. So in our calculator, let me demonstrate it in the calculator. Right, so in our calculator, we have, I forget the question. It's 12%. Okay. Right, so future value is 1,000. The number of periods is twice we're paying, so it will be 20 because it's 10 years by 2. Payment now is 100 divided by 2 is 50, and the coupon rate is 12%. We divide by 2, we get 6. So our future value is now 885. Our present value is now 885.30. So this is the present value of the bond. Alright, and we got it here in our calculator and in our Excel using present value function. We got the same answer. Now let's look at a few more examples. So this one says bond interest payments before and after taxes. How do we deal with it. Charter Corp had issued 2,500 debentures. Now, debentures is just another name for bonds, with a total principal value of $2,500,000. The bond has a coupon rate of 7%. So it simply means that this company, Charter Corporation, is trying to raise $2.5 million. And so they issue 2,500 bonds. If you multiply 2,500 by 1,000 bonds, you would get the 2.5. That's how they'll make up their 2.5, by selling 2,500 bonds. The question asks us, what dollar amount of interest per bond can an investor expect to receive each year from the charter? Simple. It's 7% of the par value. So yearly, an investor can expect to receive 7% of the $1,000, which is $70 per bond. B says, what is the charter's total interest expense? So we just calculate the interest per bond per year associated with this issue. So if we just calculate the interest per bond as $70 and we have 2,500 bonds, the total interest expense to this company is $175. Now, assuming that charter is in a 35% corporation tax bracket, what is the company's net after-tax interest costs associated with the bond? So we have a total before interest taxes was $175. That's how much you'll have to pay in interest. Now, interest expense taxes is 37. We get a tax break, 35% of 175. The net tax after interest expense savings is $113,750. Now let's look at another one. The Salem Company bond currently sells for $995. So it's selling below par. Has a 12% coupon interest rate and a 1,000 par value, pays interest annually, and has 15 years to maturity. Calculate the yield to maturity. So what do we have? We have the present value of the bond, $955. We have the par value of 1,000. We have the period N, 15 years. We have the coupon payment, which is 12% of par, 120. We need to solve for I, which is the yield to maturity. So we input in our calculator negative. Anytime we're inputting, it's a negative, right? Because it's cash outflow to us. Negative, then positive, future value, put in the 15, 120. And so we solve. The yield to maturity is 12.68. And you can see the difference, right? So the coupon interest is 12%, but because we got the bond at a discount, the interest rate or the yield is much higher than the coupon, right? So you're getting on this whole investment 12.68%. Now let's see if we can do some calculations here. Calculate the yield to maturity for each bond. I want you to practice it. So we have for bond A, the price is $820. Par value 1,000. N will be the period, right? 8 years, 16 years, 12 years, 10 years, 3 years. I don't know why they have 3 years. Okay. But coupon 9%, 12%, 12%. So let's calculate the payment, right? We don't have the payment, but we need a payment for the yield to maturity. So our payment will be 9% of par, which is $90. 12% of par, 120, 120, 15% of par, 150, 5% of par, $50. Now solve for YTM. I'm going to leave you all to do this one in your calculator or your Excel sheets. Or if you want to use a long equation, you try it out and see if you can get the figures. Remember, you have PV. PV will be entered as a negative figure, right? All the present values will be entered as a negative figure. And I want you to solve for your YTM as your practice.